The inevitable is about to happen to gold. For decades, one rule never broke. Until now. Somewhere in a room most people will never see. A decision is already being made, a decision that will decide who protects their wealth and who watches it quietly disappear. The signs have been there for months, hidden in plain sight, in central bank vaults, in bond yields, in the quiet panic of institutions that never panic out loud. And by the end of this story, you will understand exactly what is coming and why so few people are prepared for it. Welcome back to Precious Metals Intelligence, the channel built for those who prefer to understand the system before the system moves. If you are new here, thank you for spending the next few minutes with someone who takes your time and your capital seriously. Before we begin, it would mean a great deal to know one simple thing. Where are you watching from today? Please share your city or country in the comments below. It helps this community understand just how far these ideas are traveling and who they are truly reaching. For more than 40 years, gold followed one simple rule. Investors did not need a finance degree to understand it. They only needed to watch one number, the real interest rate. This is the return an investor earns on safe government bonds after inflation is taken into account. The rule worked like this. When real interest rates rose, gold fell. It made sense on paper. Gold pays no interest. It sits quietly in a vault or a drawer, earning nothing. So when a government bond started paying a solid, safe return, money moved away from gold and into that bond. Why hold something that pays nothing when something safe pays 5%? For 4 decades, this relationship held firm. Economists taught it. Traders relied on it. Entire investment strategies were built around it. It became one of the most trusted patterns in modern finance, almost as reliable as gravity. Then, without much warning, something changed. Real interest rates began rising again in recent times. Central banks pushed rates higher to fight inflation. According to the old rule, gold should have fallen sharply. Investors should have sold their gold and moved into bonds instead. That is what history said would happen. But it did not happen. Gold refused to fall the way it was supposed to. It held its value. In some periods, it even climbed higher, moving in the opposite direction of what the 40-year pattern predicted. At first, many analysts dismissed this as a temporary glitch, a short-term anomaly, something that would correct itself once the market caught up. Months passed. The pattern did not correct itself. Gold kept behaving in a way that broke the old rule again and again. This is the moment serious investors began to pay close attention. Because when a rule holds for 1 year, it might be luck. When it holds for a decade, it becomes trusted. But when a rule that has worked for 40 years suddenly stops working, something deeper is happening. It is not noise, it is a signal. Analysts have a term for this kind of event. They call it a structural decoupling. In plain language, it means the old relationship between two things has broken apart. The connection that used to explain gold's movements no longer applies. Something in the underlying system has shifted, and the surface behavior of the market is only now beginning to reflect it. This matters more than most people realize. Financial rules do not usually break for small reasons. They break when the foundations underneath them change. A 40-year pattern is not disrupted by a single news headline or one nervous trading session. It takes something larger, something structural, something that touches the deeper plumbing of the financial system itself. So the real question is not whether the rule broke. The evidence already shows that it did. The real question is why. Why would gold refuse to fall, even as the incentive to hold safer, interest-paying assets grew stronger? Why would investors, and more importantly, the largest institutions in the world, continue holding an asset that pays no return when safer options were offering more? There are only a few possible explanations. Either the market is behaving irrationally, which is possible but historically rare over a sustained period, or something about the financial system itself has become less trustworthy, less predictable, or less safe than it used to be. And large, sophisticated investors are quietly repositioning because of it. This is not a small technical detail buried in a research report. It is a warning sign, sitting in plain view for anyone willing to look closely enough to notice it. Most everyday investors do not watch real interest rates. They do not track these kinds of relationships closely. They see gold's price go up and down and assume it is simply doing what gold always does. They miss the deeper story unfolding underneath. But institutions do not have that luxury. Their job is to notice when old rules stop working. Their job is to ask why. And in recent months, many of the largest financial institutions in the world have begun asking that exact question quietly and in growing numbers. What they are finding is the beginning of a much larger story, one that reaches far beyond gold itself, into the debt levels of major corporations, the confidence nations place in their currency reserves, and the slow, careful movement of capital towards safety. The 40-year rule did not break by accident, and understanding why it broke is the first step toward understanding what may come next. Somewhere between one Tuesday and the next, something rare took place inside the walls of the world's largest financial institutions. It did not make front-page news. There was no dramatic announcement, no press conference, no single moment anyone could point to and say, This is when it happened. But if someone had been quietly comparing research notes from bank to bank during those 2 weeks, they would have noticed something almost impossible to ignore. Nearly every major institution was saying the same thing about gold. To understand why this matters, it helps to understand how these institutions normally behave. Big banks do not agree with each other very often. In fact, disagreement is part of how markets function. One firm says buy, another says sell, a third says wait. Analysts build careers on being different from their competitors, on finding an angle no one else has spotted yet. This constant disagreement is not a flaw in the system. It is the system. It is what creates a functioning market in the first place. So when 8 of the largest financial institutions in the world quietly published similar views on gold within roughly the same short window of time, without any obvious coordination between them, it stood out, not because any single opinion was shocking on its own, but because the alignment itself was unusual. Rare things deserve attention, and this was rare. Each institution framed its outlook slightly differently. Some used cautious language, others were more direct. But underneath the different wording, the core message was strikingly similar. Gold was no longer being treated as a simple hedge, a small insurance policy tucked into the corner of a portfolio. It was being treated as something closer to a central position, a place where meaningful capital should be moving. One institution went further than the others. In its internal research, it described gold as being in what analysts call an explosive phase. This phrase can sound dramatic, almost like marketing language designed to grab attention, but it is not marketing. It comes from a specific technical measurement used to detect when the price of an asset breaks away from the normal patterns that usually explain its value. In simple terms, most assets move within a certain expected range most of the time. Prices rise and fall, but they tend to stay connected to underlying fundamentals like interest rates, supply, and demand. An explosive phase is different. It is a period where an asset detaches from that usual gravity. The normal forces that would pull the price back toward its expected range stop working as effectively. According to this measurement, gold entered such a phase some time ago. It has cooled somewhat since its earlier highs, but by this same measurement, it remains above the threshold considered unusual. This detail matters, because it is not a prediction based on emotion or opinion. It is closer to a diagnostic tool. And when a serious diagnostic tool flags an asset as behaving outside its normal boundaries, at the very same time that multiple major institutions are independently repositioning toward that asset, the coincidence becomes harder to dismiss. It raises an important question. Why would so many competing institutions, each with their own research teams, their own incentives, and their own reputations to protect, arrive at such a similar conclusion within such a short period of time? Institutions do not typically move together unless they are responding to the same underlying pressure. They are not required to agree. They are not rewarded for copying each other. If anything, being the same as everyone else offers little competitive advantage. So when their views begin to align this closely, it usually means they are all reacting to something real, something they are each independently detecting in the data they study every single day. This is very different from the way ordinary investors experience the market. Most individual investors watch price charts and headlines. Institutions watch structure. They watch the underlying mechanics of the financial system, the parts that do not usually make it into daily news coverage. When institutions begin moving in the same direction at the same time, it is rarely because of a headline. It is usually because something in that deeper structure has shifted, and this shift did not happen in isolation. It is connected to a much larger and more troubling picture, one involving enormous levels of corporate debt, rising financial stress signals, and a growing sense of unease about risks that most everyday investors have not yet been forced to think about. That picture is where the story goes next. To understand why so much capital has quietly begun moving toward gold, it helps to step away from gold itself for a moment and look at a very different corner of the economy. A corner most people rarely think about, but one that sits closer to the center of this story than almost anything else. In recent years, a small group of enormous technology companies has been spending money at a scale that is difficult to fully picture. Hundreds of billions of dollars each year poured into building the infrastructure behind artificial intelligence. New data centers, new computing power, new systems, built faster than almost anything in modern business history. On the surface, this spending looks like strength. It looks like confidence. It looks like companies racing toward the future with unlimited resources behind them. And for a while, this spending has helped hold up much of the stock market. When one company spends heavily, that spending becomes revenue for another company. That revenue supports higher stock prices. Higher stock prices support investor confidence. It becomes a cycle that feeds itself, at least for as long as the spending keeps growing. But underneath this surface, a quieter and more uncomfortable story has been forming. A meaningful portion of this spending is not being paid for out of profit. It is being funded through debt. And a growing share of that debt is structured in ways that keep it off the traditional balance sheet. the financial document most investors would normally check to understand how much a company truly owes. This means the full scale of borrowing tied to this technology boom is not always visible at first glance. It takes a closer look and a willingness to ask uncomfortable questions to see the complete picture. When analysts began adding up these obligations across the largest companies involved, the total began to climb toward a figure near $3 trillion. This is not a small technical detail buried in a footnote. It is a number large enough to shift the stability of an entire sector if conditions were to change. One company in particular has become something of a warning signal for the rest. Its core business appears to be performing extremely well. Revenue is growing. Its order backlog is enormous. On paper, everything looks close to ideal. Yet a closer look reveals a different story. The company's free cash flow, the actual cash left over after expenses, turned negative. To cover this gap, it borrowed more, and it has signaled plans to borrow even more in the future to keep up with its ambitions. At the same time, the market has been quietly pricing in more risk around this company's debt. There is a financial instrument that functions similarly to insurance against a company failing to repay what it owes. The more nervous the market becomes about a company's ability to pay its debts, the more expensive this insurance becomes. In recent months, the cost of this insurance for one major technology company climbed to a level higher than it was during the week. One of the most infamous financial collapses in modern history took place in 2008. This does not mean a collapse is guaranteed, but it does mean that somewhere beneath the surface of a booming, confident industry, serious investors are quietly pricing in the possibility that something could go wrong. There is another detail that deepens this concern. One of the largest technology companies recently disclosed, for the first time, that a very large share of its artificial intelligence revenue comes from a single business partner, a partner in which it also holds a financial stake. This raises an uncomfortable question. If one company is both investing in another and counting that same company as a major source of revenue, how much of the reported growth reflects real, independent demand, and how much reflects money moving in a circle between two closely connected businesses? These are the kinds of questions that do not appear in most headlines, but they are exactly the kinds of questions serious investors are trained to ask. When uncertainty like this builds quietly beneath a booming market, capital does not simply disappear. It moves. It looks for shelter. It searches for something that does not depend on one company's balance sheet, one partnership, or one government's promise. Historically, there has only been one asset that consistently fits that description. An asset that cannot default, cannot be printed into existence, and does not depend on any single institution keeping its word. That search for shelter is where the next part of the story begins. For nearly 80 years, there was one clear answer to a simple question. If a nation wanted to store its savings somewhere safe, where should it go? The answer, almost without exception, was the United States. Countries bought U.S. government bonds. They trusted the dollar. It was treated as the safest place in the world to park national wealth, backed by the size and stability of the American economy. That assumption is now being quietly re-examined. The shift did not begin with a dramatic announcement. It began with a series of smaller moments, each one chipping away at an old certainty. Reports have surfaced showing that officials in Washington itself have expressed concern about foreign nations holding large amounts of U.S. dollar assets, and about the possibility that access to those assets could be restricted under certain conditions. When a country's own government begins openly discussing this risk, other nations take notice. They begin to ask a question they had rarely needed to ask before. Is our money truly safe here? This concern did not stay theoretical for long. Earlier this year, during a period of real financial stress, several countries discovered something uncomfortable. When they attempted to sell portions of their U.S. debt holdings quickly in order to raise cash during the crisis, the act of selling itself added pressure to an already unstable situation. The very asset that was supposed to provide safety became harder to rely on at the exact moment it was needed most. Gold behaved differently. Nations that held gold were able to convert it into value without triggering the same kind of strain. It did what a safe asset is supposed to do. It moved easily. It calmed uncertainty rather than adding to it. This distinction may seem small, but its implications are significant. For decades, the dollar performed a very specific job for the world. It was the asset nations trusted above all others. Gold is now quietly stepping into part of that role, not through announcement or policy change, but through the simple, practical decisions of nations rebuilding their reserves. China offers one of the clearest examples of this shift in action. In a single recent month, the country imported an amount of gold roughly equal to what the world's 10 largest gold-producing nations mine combined in that same period. If this pace were to continue over a full year, it would represent more than half of all the gold extracted from the earth globally. This is not the behavior of a nation making a minor adjustment. It reflects a deliberate, large-scale repositioning. China is not acting alone. Central banks around the world as a group have been purchasing gold at the fastest pace on record, with one recent quarter alone seeing tens of billions of dollars in central bank gold purchases. These are not speculative traders chasing short-term profit. These are national institutions, planning decades ahead, quietly reducing their dependence on foreign currency reserves that carry political and financial risk. There's a simple reason behind this pattern. A dollar reserve depends on trust in another government's decisions. It can be restricted, it can be frozen, it can be affected by policies outside a nation's own control. Gold carries no such dependency. It has no counterparty. Once held, it belongs entirely to its owner, unaffected by decisions made in a foreign capital. Adding to this shift is a simple physical reality. Gold cannot be created quickly. Bringing a new mine into full production typically takes 10 to 15 years, regardless of how much demand may exist. If central banks and nations continue purchasing at their current pace, meaningful new supply is not positioned to arrive for well over a decade. None of this happened overnight, but layered together, a 40-year rule that is quietly broken, institutions aligning within weeks, trillions of dollars in hidden debt, and now a slow, steady retreat away from total dollar dependence, a pattern begins to take shape. One that suggests today's calm surface may not reflect what is truly happening beneath it.